Thank you so much for tuning in to today's webinar, everybody. Really appreciate it. Taking the time out of your busy day to join us. I think we're going to talk about, well, I know we're going to talk about a very important topic today, and that is self-directing your retirement into into asset classes that you understand, that you can control a lot more than just throwing your money into Wall Street. And this isn't going to be a Wall Street bashing session, don't misunderstand me. But what we're going to talk about is a topic that I think is not talked about often enough, and that is investing your hard-earned money in retirement, Roth, traditional, IRA, 401k, etc., into assets that you know, understand, and like I said, have a bit more control on. So we're going to give it about 30 more seconds here. People are still jumping in, and then we will get started. A little bit of housekeeping. First of all, if somebody could just say, oh, thank you, Alina and Anna. We've got an aloha, perfect, very apropos, and then Anna saying buen dia, good day to you as well. So I guess you guys can hear me. I was going to ask to put some in the chat, but you already answered that question. Thank you. And then if you do have questions, please, along the way, don't wait till the very end. We are going to give time for Q&A at the end, I promise. And just put your questions into the chat as you're thinking of them so you don't forget what they are, okay? We're going to give a pretty comprehensive presentation here, but I know people will still have questions, so that's perfectly fine. We want you to ask them. All right, I'm going to share my screen now. And we do have a special guest here today, too, in case I didn't make that abundantly clear. Reed, if you could just confirm you can see my screen. Appreciate it.
Yep, looks good.
All right. Okay, excellent. Well, without further ado, let's kick it off. So we're here to talk about the investment solution for your self-directed retirement account. And I am here with a guest from Myers Investment Group who I will bring in shortly. I'm going to get out of the way as quickly as I can, but I want you to still understand if this is your first exposure to Sense Financial and what we do here. I want to just give a high level on that, and then I'll get out of the way and let our guest take over. First off, my name is Brett. I am a self-directed IRA, solo 401k consultant here at Sense Financial, and we are not a fiduciary. We don't provide tax, legal, investment, or other professional advice. My guest and I are not attorneys. We don't even play one on Zoom. And if you need such advice, please seek out the proper professional. What we are providing here is education, and at Sense Financial, we don't tell people what to invest in. We will just introduce them to different options. It's up to you to do your own due diligence and bring the strategies, et cetera, that we are talking about here today to your professional to get that type of advice before you move forward with something. First of all, Sense Financial, we are a boutique financial firm that specializes in self-directed retirement plans, but it's not just self-directed retirement. That's the niche, but the niche within the niche is that all of our plans have what's called checkbook control. So you can actually bypass or eliminate the custodian when it comes to investing and in some cases making contributions without that red tape, transaction fees, timelines, delays, et cetera, that come along with having to go through a custodian. We've been in business since 2010, well past the startup phase. Our clients love us. We do have 5-star reviews all over the place, so feel free to check that out. And then we've assisted well over 4,000 clients establish over 5,000 different types of self-directed retirement plans. I'm going to cover those two that we specialize in a moment. And then I think another testament, not just the reviews we have, that our clients are satisfied, in some cases love us, is that most of our clients actually come from referrals. And most of those referrals come from existing clients. And then some of those referrals come from partners, like our guest here today, and CPAs, et cetera. And then just to give a high level on the self-directed IRA and the solo 401k, which, by the way, are the only two types of retirement accounts that we specialize in here at Sense Financial. Dimitri, the founder, when he started this company in 2010, he knew that he would have to say no to a lot of shiny objects along the way. And he's done that, and it's proven to be a good choice because we do what we do at a very high level because of the focus that we're able to have without having all this other stuff going on. So what do the checkbook IRA and solo 401k allow you to invest in? Well, pretty much anything except for collectibles, life insurance, and some rules regarding prohibited transactions, disqualified parties. Easy way to think about that is if you invest arm's length without involving your immediate family, it's probably okay. But always ask the question before you do it. The returns can be either tax deferred traditional pre-tax funds, or they can be Roth. We all want more money in Roth. That's tax-free ATM withdrawals at the end of the day, right? You can leverage your funds with what's called non-recourse financing. So if you're going to purchase a rental property, for example, inside the IRA or 401k, you can get what's called a non-recourse loan, which basically means that you, as the owner of the plan, are not providing a personal guarantee. Because you're a disqualified party, you can't do that. So the property is the only security for the loan at the end of the day. You can't do that in Wall Street. Now, you can trade on, what's it called, margin or whatever. I'm not talking about that, but traditionally, no one's going to give you money to go buy more S&P 500. So really think about, as you're listening to this, and we're not necessarily here to talk about owning rental properties today per se. It is an option, but that's not necessarily the focus of this call. But you certainly can do it. But beyond that, think about, as you're listening to this, what would it be like if I had true control over my retirement account instead of just throwing it to a financial planner to quote unquote actively manage for 1% of all assets under management, or just throwing in the S&P 500, which, don't get me wrong, over a long period of time, you can get a fairly decent return. I mean, historically, it's like 10.5% or so since its inception. But if you may be on this call and you may not be the spring chicken that you once were. And so you need to do something that may be a little more aggressive, but also wise at the same time. So kind of think about that as we're talking today. We talked about the checkbook control. The solo 401k is definitely a tax shelter. We call it the ultimate retirement plan because you can contribute up to $81,250 a year from your adopting business, from your self-employment, either tax deferred or Roth after tax, or a combination of the two. So it in a lot of ways, it's the ultimate retirement plan. We don't have time to dig into all the details of that today, but just kind of planting that seed. I talked already about the unlimited investment options, or almost unlimited, but some of the major, more common asset classes are cryptocurrency, precious metals, real estate, both commercial and residential. By the way, syndication, REITs, private lending, your IRA, 401k can become the bank. You can loan the money out to fix and flippers or investors, or even owner-occupied properties. I mean, the sky's the limit almost. Tax deeds, you can buy in the courthouse steps. With checkbook control, it's pretty easy to do that. If you have to go through the custodian for the transaction, it's really not possible to buy in the courthouse steps. So another reason why having checkbook control is a good idea. And then we just believe it does provide true diversification. Divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth, in Ecclesiastes 11:2, and that's true, right? Like 2008, of course, the big one that we had last. But even COVID, there was a little blip. Obviously, real estate went completely bananas shortly after that, but there was a blip, and people saw a hit in their retirement, and we don't know what's next. I mean, who knows? World War III, God forbid, who knows? But if you're diversified, especially into asset classes that are secured by a hard asset, okay, it's different than just having your money invested in something like the stock market, where it's just businesses and companies. Elon doesn't care about me. I can't call him up and say he's running this company wrong. I can't do that. But if it's secured by real estate, if there's a default, you can foreclose, get the real estate. It's just a lot, in my opinion, it's a lot safer, okay? But again, we're not providing investment advice, just giving people options. So without further ado, I am now going to introduce our guest here, Mr. Reed Myers. As principal of Myers Investment Group, Reed brings its extensive expertise in real estate investment and mortgage lending. With a background spanning private money, consumer, and commercial lending, Reed has successfully guided numerous capital investors toward meeting their financial and investment goals. With a focus on strong customer service, Reed previously served as an investment analyst for a prominent commercial real estate investment fund in the Southeast, gaining experience in real estate development, retail positioning, and business acquisitions. Quite the accolades here. With over 17 years in residential and commercial lending and real estate investing, he's also the principal of Myers Capital, a mortgage banking company and direct private lender that has served clients throughout the country for over 25 years. Reed, thank you so much for joining us. I am going to stop my screen share so you can take over. Really appreciate you being here.
All right. Thanks, Brett. Yeah, I really appreciate the opportunity. Yeah, just a side note, I've been very impressed with Brett and Sense Financial, and we work with a lot of self-directed IRA companies. And Brett and his company really stand out as to kind of the service and the product line offering that they deliver, not to mention the educational content. So yeah, appreciate that, Brett. So yeah, my name is Reed Myers. I'm the principal of a few different companies. Primarily today we'll be talking about Myers Investment Group, which is our capital management company, where we provide basically passive mortgage investing opportunities for you to invest capital in. As Brett mentioned, I'm also the principal owner of Myers Capital, which really our story on that is it goes back to 1998. My father started the company actually in the Southeast, and I came on board kind of unwillingly at a younger age after working for basically a real estate investment trust in the Southeast, and basically cut my teeth and kind of worked my way from the ground up, started in processing and slowly got my license, and had this crazy idea to move back to Hawaii close to 15 years ago to open up a branch. Why Hawaii? Was born in Hawaii, but I grew up in the Southeast. So that was kind of my, just became my goal as a young adult to try to get back here in any way I could. So I did. So we've been very fortunate. We have plenty of clients. I really had to start from scratch when I got out here. Didn't have much of a network, and we've since built our company up to doing basically loan volume for a small boutique company like ours over the years up to over $1.5 billion. And we have thousands of clients throughout the islands, and we still lend in what we call the mainland. That's where probably most of our viewers are from. There's some in Hawaii, I see that. But yeah, so that's kind of our background. And we've over the years, a big part of our presence has been really kind of client customer service, keeping it very personal, very approachable. I like to be personally involved in a lot of the conversations we have with clients and investors. So I take a lot of pride in that, as Brett and I were kind of chatting about initially. So I will go ahead and grab the screen here. I know you guys are anxious to get into some details of how these investments can help your portfolio.
By the way, I totally tried to find a Hawaiian shirt to wear today, and I even asked my wife, I'm like, where's that Hawaiian shirt we wore like 6 years ago, and we were in Hawaii together, and
yeah. Oh, you could have told me. I could have sent you a fake lei or something.
There we go.
All right. Can you guys see my screen okay, Brett?
Yeah.
Okay, great. All right. So yeah, today we're basically going to be talking about, these are called, technically we call them high yield short-term mortgage investments, kind of a long name. Basically, what I want to have you take away in this presentation is think about this as you are the lender. Think about it, you kind of hear it often, be the bank, right? But I'll go into more details on that. But that's a short way of thinking about things. Keep it simple. It's about lending money against real estate and earning a return. Okay? So we got some of our disclaimers here, of course. If you guys want to copy the presentation, feel free to reach out to me or my team after. And yeah, small update. I'm honing in on 20 years, Brett, so I think I need to update that bio. But I think we chatted about some of this, my background, some other key factors too. I've had my real estate license and my appraiser's license in the past. I don't do that at all now, but it kind of gave me a background into just understanding more, basically being able to do my job better as a mortgage professional. But that's not something I actively practice. We've been fortunate, me and my team have been fortunate to be featured in Mortgage Professional America. That was actually pretty recent, and PBN, Pacific Business News Hawaii, and over the years, and we've just been really fortunate that people have talked well about us. We have great reviews, and been fortunate to have that opportunity. And I'll kind of skip over this because I think we have enough of an intro on it, as well as this. Side note, we do lend in about 48 states, including, obviously most of them are on the mainland, contiguous United States. So even though we're in Hawaii, because of our background and our reach and our history, being in the South Carolina and being in, actually we had some branches in Richmond, Virginia over the years, we still keep a lot of clients and do a lot of business, a lot in the Southeast as well. Okay. So our mission at Myers Investment Group is really try to bring our expertise from the mortgage lending background and to provide these investment opportunities to basically allow you to have consistent investment yield and without the volatility, and just really providing full education on how this works. So, all right, so let's talk about returns. Everybody's very interested in that, as I would be. You got to think about it. We're going to be working on a slide. I'd like it to be inputted here, but a big difference you have to think about with mortgages as opposed to acquiring real estate or being involved as an equity partner in perhaps real estate syndication deals. Now, a lot of you have probably done research already on, well, what is a real estate syndication deal? Well, essentially what you're doing is you're being an investor into equity into that deal. Well, and that's great. There's a lot of deals out there that can do very well. Operators, if they're very good, they can perform very well. Some of them, obviously, may not. But it's important to understand as an investor your risk profile, where equity is usually one of the first piece in the capital stack to be at risk. So now, don't get me wrong. Sometimes they can, and I've invested these in the past as well. So it's not something that you need to just avoid. It's just something you need to be aware of. But where we come in as debt on the capital stack is we become basically, most of the time it's first in line. We're the first to get paid off if a deal gets into trouble, right? So this basically translates to what's called loan to value. Loan to value is how much we're going to lend on a piece of real estate compared to the value of the property. And side note, our average loan to value across our entire portfolio is around 60%, thereabouts. So on average, on $1 million property, to make it easy, on average, we're lending somebody $600,000. So if they default, what does that mean? Well, we get to take over a $1 million property. We're only owed $600,000. Theoretically, we can sell it, and actually, sometimes in many cases, we may have a windfall if and when that happens, even though that's not the goal, right? It's not the goal to foreclose. But it's important to understand that in the debts and the capital stack, where mortgage debt is. Okay, so returns, we average annualized returns net to investors anywhere from 10 to 12. On average is about 11. That's really kind of what we found where we can push the limits of yield, but still have good quality deals because it's a balancing act. I think Brett and I chatted about this. A lot of our business as an operator and a capital manager is about balancing clients, right? Which in our case would be borrowers with investors. So we want to get paid for the risk that we're taking, but also not push things extraordinarily high where we're not going to get quality borrowers, and the quality of the leads and people that are wanting to borrow money that come in starts to decline. That's not what we want, right? So it's basically an art and science, balancing that risk and reward level. But that's basically where we fall. And then distributions are paid out monthly or quarterly, just depending on the investment channel that you come in under. And again, like we talked about, these are all mortgages, so secured by real estate. Primarily, these are first lien positions, but we also have here and there some second lien positions that pay out more. Okay, term. So term of the loan. When you invest in these deals, essentially we call these direct mortgage investments. You are essentially now becoming the mortgage holder, or what's called the mortgagee. The borrower is what's called the mortgagor. They are mortgaging their property to you or your entity. So basically you will own the note or a fraction of it, just depending on the structure. Now typically these terms are anywhere from 6 to 12 months. So that's basically your investment timeline. So you invest your money, loan gets paid every month, and then once it gets paid off, that's called maturity, you get your principal back. And we'll talk about how the loans get paid off. All right. So just real quick, the investing timeline and how this works. So number one, from a high level, you just invest your capital through whatever vehicle that you want to invest through. That could be a taxable account, self-directed IRAs, solo 401ks, right? And obviously, if you're going to invest in some sort of self-directed IRA vehicle, definitely have a conversation with Brett and his team. Number two, well, somewhere in between 1 and 2, we basically kind of put you on our list as a qualified investor. We would have a suitability call to ensure that this is a good, investment for you. I ask you a number of questions about, what are your goals? How much are you looking to invest? What's your timeline? What's your risk profile? What's your experience? Right? It's not a fit for everybody, and these are things that I always like to try to uncover, during that conversation. Once we find that you're suitable, we basically bring you opportunities that a lot of times we've already closed on these loans. So closed means we've closed on the deal. We've already lent the borrower the money. We already have closing documents. Obviously, everything is recorded. And we're coming to you and saying, hey, we've got this opportunity. We've already closed on it. We may have collected a mortgage payment or two, and there's X payments left. And if you're interested, let us know. And so that's where we come in and we would assign the mortgage over to you. That's called an assignment of mortgage. Number three, of course, then you start collecting your interest every time the borrower makes their payments, which are typically monthly. And usually we structure our loans to be due on the 1st with 5 days of grace. It goes through our professional licensed servicing management company. Servicing, as I'm sure most of you are maybe aware, I'm presuming most of you have had mortgages in your lifetime. The mortgage statements that you get with the name on it, that's your servicer. It's not necessarily who owns your loan, but that's called mortgage servicing. So we take care of all the servicing. However, we don't do it all in-house. We actually use a company called FCI out of California. They're a very big licensed servicer, very big in the private lending space. But essentially what happens is when the borrower makes their payment at the beginning of the month, when it goes through everything, the distributions, as you may call it, they usually come out around the middle of the month. So, all right. I think most of this is pretty understood. Why passive mortgage investments, where you get the backing of a hard asset in real estate. You start participating in real estate, but just without all the management, the headaches, the finding the deals, things like that. You're letting your borrowers do all that work. And you're basically sitting back and collecting a very healthy return from lending them money, but it's still protected by the hard asset. And these are kind of self-explanatory. All right, so let's dive into some actual case studies that we've had. Some of these are active, some of them have been paid off. And these are fairly recent, within the past, 12 months, somewhere 6 to 9 months. So most of our loans are going to be in Hawaii. I would say maybe 70% or so. So I think all of these except one are in Hawaii. This was a great example of somebody we lent to, a borrower who's very sophisticated. They're a very prominent real estate investor here in Honolulu. They acquired this multifamily complex, and they had about a 12-month time frame. We lent them $1.15 million, which included what's called a construction holdback. So the way that works is essentially we lend them money to acquire the property. Usually that's 70 to 80% of the acquisition price. Now, if they're planning on doing renovations to the property, we may grant them that, but we will hold it back in our bank account as a construction holdback. But they're still liable to pay that back to us if and when they what's called draw on the money. So essentially, it's kind of like saying, well, we'll lend you money to buy the property. You got to come in with your 20 or 30% down. And if you need 200 grand to renovate it, okay, we'll consider it. And I'll ask them a question and say, what do you feel like the property would appraise for once the renovations are done? That's called ARV, or after repair value. In this case, it was $1.609 million. Of course, I'm going by their word initially, assuming they've done their due diligence or at least looked at comps. We're going to re-verify that once we get a full appraisal on the property to verify the ARV. So very important. So overall, this particular one, we lent him total loan, which included the portion to buy the property as well as the construction holdback of 1.15 million. So if you take that divided by our ARV, you get about 71.5%. So that was our total exposure at the end of the day. Was we lent him about 1.1 million, property is worth about 1.6. So we were very comfortable with that. In fact, especially in his case with his substantial experience in doing these kind of projects in this area. And our yield on this net to our capital investor was about 9.6. A lot of people ask, well, how do we get paid? And I'll touch on that a little bit later. But basically, whatever the note rate is, we make 20% of that. We pass on 80% to our capital investor. So if we're lending at somebody at 12%, and that was the case here, then our capital investor was earning 9.6 yield. So this is on the lower end, but keep in mind, this is a very experienced borrower. He was aware of his capabilities. He wanted to partner with us. He was looking for a true private lending capital partner, especially here in Honolulu. But he also, he knew he was a strong borrower, so he wanted terms that could make sense. So we came to terms on that and lent him the capital at 12%. So our investor, we had one investor take the whole note. He earned $110,400 monthly income, $9,200 a month. All right, so Brett mentioned non-recourse financing early on. And it's kind of interesting because we do provide non-recourse financing. Non-recourse means the borrower is not personally guaranteeing the loan. And you say, well, isn't that more risky? And the answer is, yeah, it is in a way. If you're lending it to somebody who says is in a way kind of a weaker borrower, or there's a possibility of heavy default or something like that, obviously we wouldn't lend to them anyway if we knew that up front. But with a 1031 exchange, as most of you may be aware, where an investor will sell a property when they have substantial gains in the property, right? What they sell it for minus their transactional cost, minus their cost basis, generally the structure. If they got substantial capital gains in the property, they can sell their property and move it into a like kind secondary property and shield and defer all those capital gains for a later date. That's called a forward 1031 exchange. A reverse 1031 exchange is the opposite, where you actually buy the replacement property first before the old property sold. And that's what we did in this case for this particular borrower. This one was unique because in reverse 1031 exchanges, the way we structure them with a non-recourse carve-out. So again, we would only do that for a very strong borrower, a very strong situation, and we had that in this case. So we helped the borrower acquire this $800,000 piece of land in Kamoela, Hawaii. This is called the Big Island. And he came in with, about $300,000 of his own capital. We lent him $500,000. So our exposure was very low. Our LTV was 62.5%. And in this case, we structured, I think it was around maybe 13% was the note rate, so 13%. And our capital investor, actually, we had one take the entire thing. So he invested $500,000, took the entire note, and he was earning 10.4%, giving him an annual yield of $52,000, monthly at $43.33. And this one is not paid off yet, but it's been performing every month. And we're in active communication with the borrower about his exit strategy to pay us off. So very, very good deal. That's working out very well for everybody. All right. And so here's one of our mainland deals that we originated last year. The borrower is about 90% complete with the renovations. Very similar to the first deal that I showed you, where we helped them acquire the property. We gave them a construction holdback to renovate the property. And the way a construction holdback works, by the way, is we do not just disperse it to them to start on the renovation. They have to come to us in reimbursements. So what does that mean? Well, let's just say it's a larger project or even a ground-up construction. Let's just say it's $500,000 in renovations. They have to front their own money, and we will verify that they got the money to do that before we even close. But they have to front their money. They can certainly spread it out into phases. So let's just say 5 $100,000 phases, totaling $500,000 renovation project. We will they will have to do, let's just say phase one, they have to do the work and have it be completed before requesting the reimbursement on their construction draw. So what they do is they'll do the work, they have to pay all the subs, pay all the contractors and GC if there is one, and then we come in and re-inspect. They say, hey, great, Reed, we're done with our phase one. Can we request our $100,000 draw? We'll say, great. We send out our inspector. We verify all that's done. We verify the invoices are there. We get contractors to sign off on lien release waivers saying that they've been paid or are going to be paid by us. And so it's very much a structured process. Then and only then do we then release the money, the draw to the borrower. So it's a way to help them throughout certain increments of phases in their project without being exposed and just giving them money and hoping that they pay the contractors and do the work, right? That's not a position we want to be in. So a lot of this, if you think about it, it's kind of common sense, right? But we've got all our systems and procedures dialed in to make sure that everything is running smoothly. So this particular one, I think this one was a 13.5% rate. Yeah, so the note rate was 13.5%. Again, passing 80% to our capital investor. That's an annual return of 10.8. And this particular deal we actually kept inside of our fund. I'll kind of mention what I can about our fund here at the end and the different vehicles you can invest in and through with us. But in this case, our fund is currently earning about, we're earning $10,455 a month, and that's net. All right, so I've got one more here. I hope this isn't too overwhelming or complex. Trying to help keep things simple. Again, if anybody has any questions about specifics, feel free to reach out to me after the webinar. Email me. We can schedule a phone call and be glad to go into more detail. Okay, so this one was this was our first one of our the second lien. This is a second mortgage note. So you'll see right off the bat the 13.2 and say, great, that's much better. I love that number. And keep in mind, risk and reward, right? The higher you push on yield, the more risk you might have. That's the way it is. And the same thing with real estate syndication deals, right? So now we're still in debt position here. We're still in the capital stack. We're still debt. We're just behind the first lien lender. So this brings with it different complications, not complications, but different considerations that when we're sizing up deals, would we even consider this for ourselves, myself personally, because I personally lend on these types of deals as well with my personal capital, into making sure that we're protected and this is strong. Again, we don't do a lot of these, but when we do them, we make sure we're extremely conservative and this is a very strong borrower. So in this case, we had a borrower finishing up a project in Kamawela, Hawaii, and beautiful, beautiful area. It was a high-end home. They were about 95, maybe even 98% complete, and they had a first mortgage construction loan on the property. In this case, I think it was about, I want to say it was maybe $2.5 million, somewhere around there. I kind of have to work backwards from the numbers, but it wasn't small. But in relation to the completed value of the project, again, keep in mind they're almost to the finish line. The property, we appraised it at $6.5 million. So they were requesting a $500,000 mortgage. Again, in this case, they didn't want to replace their first mortgage. They just wanted to do a second. And we looked at it, we dug into it, and we got comfortable with it. So they needed the capital to basically really do finishing touches on the project. They wanted to do some upgrades that would, their real estate agent was, again, their goal again was to finish this and sell it. This is a spec home. Sorry, not a spec home. It's a custom home they were building in an exclusive neighborhood, actually where Shohei, the pitchers for the Dodgers, actually just recently bought a home. So there's this big marketing thing about it as well. And they were kind of riding that wave. So the borrower came to us. He wanted $500,000 to do these just end of the line finishing high end touches, and actually kind of spend some good money staging the property, do some nice finishing touches on the landscape, and that's what they requested. So they had excellent credit. These were experienced builders. I think they were out of the West Coast somewhere, and I believe they were licensed in that area, but this was their own personal project. They had a lot of capital in the deal of their own personally. And so we structured a 16.5% second lien. And that basically paid our capital investor 13.2% annually. And this deal was just recently paid off. I think they paid it off in maybe 6 months, something like that. So again, when we get paid off, what does that mean? Well, it means the loan's paid off, right? You get your principal back. You've been earning interest throughout. And but keeping in mind that you get paid back your principal, and you say, great. First thing that usually comes to mind if you had a good experience, which again, most of the time you do, is, well, when's the next deal coming up? I got to redeploy my money. So I kind of talk about that if we have time. Brett, how am I doing on time?
You're good. We should probably wrap it up in about 5 minutes for Q&A.
Okay, great. All right, so yeah, those were our numbers on this one. And let's just kind of go into how you can invest. So minimum investment range for self-directed deals, or direct mortgage investments, as we call it, it's $150,000. For these deals, we want you to be accredited. Accredited means you have $1 million net worth, not excluding your primary residence, or the income qualification shown here. And you can look this up pretty easily. We do have other ways where we can bring on sophisticated investors, but I have to talk with you directly offline about that. And we do have some institutional partners as well, but most of our investors are high net worth or accredited investors. And what can you use to invest? So obviously any taxable accounts, checking and savings accounts. You can invest with self-directed IRA or a solo 401k. Again, that can be traditional or Roth, doesn't matter. The only thing you can't do is invest through your regular Roth or regular traditional IRA, as you know, those are basically structured to only invest into publicly traded securities, which this is not. These are private placements for individual accredited investors. Some people will maybe take out loans against their 401k. Again, do that carefully because you're borrowing the money. Same thing with existing home equity lines of credit, HELOCs. I've had some clients do that. Mainly if they had some very good rates that maybe they've helped secure, which maybe we helped them get. I have a client right now, he's sitting in a beautiful position. He's got $1 million line of credit on his home, and he locked in like a 2.75 rate, but it is going to be expiring soon. But that cost of capital, I've had investors that borrow against low lines of credit or low mortgage rates and invest it with us and earn the 11% and get an arbitrage on that yield. So very, very smart. But again, you got to be careful about how you're doing it and understand the pros and cons. Stocks and bonds, how do you invest with that? Well, you got to sell it. So liquidate when the market's good. I get a lot of questions about discount Roths nowadays as well. That's another great way to do your Roth conversions while the market's down or those investments are down, and bring it over where you're, and I'm sure Brett can touch more on that, so I won't go into too much detail on that. But yeah, just a number of different ways that you can bring in capital to invest. And this is our contact information, so of course you guys will probably have this on your emails. And thank you so much. Really appreciate it. Hoping it wasn't too long-winded, and yeah, I'd be glad to field some questions from everybody.
No, that was good. Thanks so much. One kind of area of capital, I guess, for lack of a better term, that you didn't have on there are life insurance. And we don't do life insurance, so I'm not really an advocate for it necessarily one way or the other, but it just seems to me like with that whole infinite banking kind of concept that someone could take a loan from their whole life or universal policy and then invest it with you guys, right? I mean, that would be an option, I would think, as well.
Yeah. Either way, it's I don't know exactly how those get paid back. That's just not really, but that would be a question for your insurance agent, right? But I'm sure there's a cost of borrowing, right? So if you can borrow at 4, 5, 6%, you invest at 11. But again, you understand the risks, the pros and the cons. You're making arbitrage, right? It's
It's just like the HELOC, right? I mean, Brad,
just like the HELOC, yeah. But again, I don't. You got to be careful with that because
for
you're
sure.
leveraging real estate and you're obligated to pay that debt service typically every month, right? So you got to make a payment and then you got to wait on your interest to come in. You gotta know what you're doing and be careful with that.
Exactly. Well, we do have a few submitted questions, so let's cover those. Let's see. I'm going to try this. I think it'll show up on the screen, which is kind of cool, for a few seconds. Okay, Dan is asking accredited investors only, which you covered, outside of some exceptions where you maybe have a personal relationship. So I don't know if you want to add to that at all.
Yeah. Yes. So here, public forum, accredited investors only. I think I went through the requirements. You can easily search that. If you're not accredited, reach out to me and we will schedule a meeting to go into further detail on how you can invest. So there's a process to it. I have to follow rules as far as security regulations. So I'd be glad to explain how that works.
Cool. Jack is asking, the assignment of loan would also be an assignment of risk too, correct?
Correct. You get the risk in that, you own the mortgage, right? So you're the owner. Now, even after we assign it to you, like I mentioned, we don't leave you hanging. You're not high and dry on your own. This is part of what we earn, our 20%. Again, after we've assigned it to you, we're making sure the borrower's making the payments. We're following up with them if they're not, understanding any challenges, changes in the business strategy or the exit strategy, how they're going to pay our loan off. Because then there's a maturity date, right? Following up on their construction, making sure things are on time, budgets on time, anything, getting ahead and being proactive of any possible changes or things that are coming up and communicate it directly back to you. So in that sense, we're dramatically lessening your risk because we don't expect every capital investor that's interested in taking these deals to understand how to manage it, right? So there are some private lenders, as they call it, and they just assign over a loan and you're on your own, right? And that's fine. That's their business plan and that's how they do it. We don't do that. It's very much, we're very hands-on with it and with the deal post-closing and with you, keeping you updated on things and changes that are coming up, right? So in that sense, we dramatically reduce risk, in my opinion.
Excellent. All right, George is asking, what happens when a property is paid off after an investor has invested in the property? Which you also kind of covered, so I'm not sure if you have much to add to that.
Well, when they're paid off, you get your principal back, right? And up to the date that you're paid off, you earn interest to that date. That's called a per diem. I don't quite understand the last part of it, but maybe it means that, what do I do with my money after that point? That's, well, we got to find you another deal, redeploy it, or we can talk about the strategies to that offline.
Yes, Paul, thank you for asking. Everyone who registered for this will automatically be sent a recording. Let's see, the questions are rolling in now. Okay. How do you prove that you're an accredited investor? Georgia, you could talk to your CPA. They can usually write a letter on your behalf. And again, to Reed's point, just Google, accredited investor, and you'll get a slew of information about it, but it's really not that complicated. And then
a couple things on that. Yeah, you can do
go ahead.
CPA, financial advisor, attorney can write you a letter. That's usually kind of what I hear the simplest. There are companies out there that will put together an accredited letter for you if you are accredited. They're going to charge for it. I don't know the costs on it, but there are companies out there that will do that. They're going to require obviously all your financials, etc. So a few different ways you can do that.
Yeah. Let me add too that if you are investing with your retirement account, IRA, 401k, you personally will have to be accredited. The retirement account cannot be accredited. That doesn't make sense. So just
same thing with an LLC or a trust, right? You don't hide behind that in that
That's right.
sense. Yeah.
That's right. Okay, Anna's asking, any stats on your default rate?
1 to 2%, very low. Yeah, we're very proud of that. We turn a lot of deals down, a lot of borrowers down, situations that don't work for us. So, yeah.
Excellent. How long does it take to go through a foreclosure once you determine that is the best way forward from Kirk?
Great question. It depends on the state. Fortunately, we haven't had to do many of these, but yeah, I mean, it varies, right? Just depending on the reason for the foreclosure. Things to be aware of are, it's all about protecting our equity, having a substantial equity cushion, right? The LTV and what we're lending on and why. Because there are situations, right, where the market value of the property, obviously that can change, right? But again, we like to lend on deals, and we like to lend to borrowers who have in a way, a lot to lose. And I like actually lending to borrowers who complain about the mortgage rate, saying it's so high, and there's a reason for that. Um, if somebody is more than willing to just take a rate any rate I throw at them, it tells me a lot of things about their position, their character, where they're at. We're obviously going to lend where we're comfortable anyway. It's kind of a take it or leave it type situation. It's got to work for the borrower, and it's got to work for us, because I represent our capital investors, and and protecting that money and making sure we're getting good yield for the risk that we're taking. But we like to lend to borrowers who are sophisticated, they're experienced, and this is part of why we like Hawaii. There's so many multimillionaires in Hawaii, and I know some of our viewers here are from Hawaii, and they're very familiar with this. They're probably nodding their heads, yeah, that's true. And you don't even know that they're multimillionaires. It's like the millionaire next door sort of situation. But they own, most of Hawaii has its wealth built up in real estate. So, and you say, well, okay, great. Well, why would somebody who's a multimillionaire want to pay 12, 13, 14, 15%? It's like, great question. Speed, convenience, situation, aggravation they want to avoid, all of that. The condition of the property. It's not because they've got a 400 credit score and this guy's got 10 grand to his name and he's trying to max out, cash out on his property, or he's a newbie real estate investor getting started, right? It's not that. It's smart real estate savvy investors know that sometimes speed trumps cost. Sometimes convenience or situation trumps cost. And the whole point again is they're incentivized, if they're smart and they're savvy and they're going to execute on their business plan to pay us back, they want to pay us back as soon as possible because they've got so much to lose too. They don't want to go to foreclosure when their property is worth $2 million and we're lending them $5 million. It doesn't. It's a whole lot to lose, and we don't want them to lose it either, right? So it's both, right? It's got to be a win-win, but it's definitely situational specific as to why borrowers reach out to us.
Excellent. Great info, man. Love it. All right. Onyx, what if you only have $50K to invest? Can you invest with partnering with other investors? Actually, that's a question I had too. I was wondering if you guys do fractional kind of notes and stuff like that. But.
We could talk about it. It just gets to be a little bit smaller below our threshold, but again, I'm about building relationships both with borrowers and capital investors too. So certainly just, it's not a no out of the gate, but just reach out to me. We'll kind of talk about the situation.
Cool. Okay, Anna is saying many of your examples involve single investors. Posts you do pool. Oh, that's pretty much the same question. So
yeah, similar, but like she might be referring to fractionals. So if we have a $500,000 deal, right, that we open up to our capital investors, and you got $250,000 to invest, then you can take half, and we might hang on to half, or you can take half, another investor can take half. So those are called fractionals. And then the other side of it is, again, we have a fund, but I can talk to you about it offline and talk to you about how, down the line you might be able to get involved in that. And that's, just something I can explore with you.
Cool. Lots of good questions. You really already covered this, but I don't know if you have anything to add. Is there a minimum investment amount? I think you said 150, and then you just kind of added some color to that in the last 45 seconds.
Right.
Since equity is usually returned within 12 months, do you have the volume of business to be able to reinvest those monies quickly? That's a good question.
Yeah, really good question. We've got the volume. I always have investors. I'm very open with where we're at in our volume. Sometimes we have too much. Brett and I were talking about this too, like cash drag. What is that? We're either as operators, fund managers, syndicators. We're always dealing with either we got too much capital or not enough. So, and I had one investor the other day that said, hey, I want to invest this amount, and it was relatively large, and I said, great. To be honest with you, I can't probably take all of it until maybe I can take some of it now, and I can take some of it in the next 4 to 8 weeks. Just depends on how things evolve. Because at that particular point in time, we had a few very large loans get paid off, and we're sitting on too much cash, right? So, but yeah, to answer your question, it's just about open communication, being proactive. This is where us being proactively communicating with the borrower and understanding, trying to predict when they're going to pay us off comes into play. So let's just say you took a 12-month deal by month, and then we're always talking to them usually every quarter. So by month 9, I kind of have a very good idea of, are we going to get paid off in month 12 or thereabouts, or is it going to go beyond, which is a conversation I would have with my capital investor, you, if you want to extend, and I give you my thoughts and pros and cons on it. But usually, if it's a good borrower making payments, your strategy is still sound. If somebody needs an extra 2 or 3 months and they're paying on time, why not, right? Again, situational, but yeah, so we be proactive on really trying to predict when they're going to get paid off. And then if that's the case, and you're really ready, you're going to reinvest when you get paid off, we will start flowing deals to you and earmarking them for you. Again, if we can predict all that, right? But yeah, we've got a lot of volume. But again, we also have a lot of capital investors, more and more every day, being very interested in what we're doing. So it's a balancing act, right?
Definitely. I am going to touch, if that's okay with you, Reed, on the whole Roth conversion at a discount conversation, because while it is an advanced strategy, I think it's an amazing topic that everyone should, if you haven't heard of it, you should at least have a seed planted about how it works.
Right.
Okay, cool. So there's a few different ways to get money in Roth. Well, really two. No, three. A straight Roth contribution, right? Whatever that is, dollar for dollar, is being added to your taxable income for the year. You're paying taxes on it today, or this year rather, and no taxes on that principal because you already paid taxes on it, and then no taxes on the growth, right? That's the Roth, kind of the reverse of a traditional contribution. However, the second way is to inherit a Roth IRA. That doesn't happen to very many of us. The third way is to actually do a Roth conversion. And when you do a Roth conversion, you can convert the cash, you can convert an asset. An asset could be stocks, bonds, mutual funds, ETFs. An asset could be a piece of real estate. It could be a private loan. It could be a syndication that the IRA is invested in. It could be any asset. Now, when you do an asset, IRS requires you to get a third-party valuation on that asset, because otherwise, how do you determine what the dollar amount is of the conversion? So if I have a $150,000 investment, for example, with Myers Investment Group, and I go to this third-party valuation company, I say, hey, this is a traditional investment in my 401k or IRA, kind of the same principle. I want to convert this to Roth. They will do their appraisal process. You'll get a whole report. It's quite a few pages, all above board. But because there's a few factors going on, one, there's an argument for lack of control because it's inside your retirement account. And two, it's an illiquid asset, right? It's not easy to just turn around tomorrow and turn that into liquid capital. And there's a few other factors, but those are the major ones. Because of that, my $150,000 principal investment will, I'm not going to say I can guarantee it because there's no such thing in this world, but in the world of investing, that is, but it will 99.9% of the time come in less than the 150 at a discounted rate. We've seen between 20 and 60%. And so I've heard reports of even higher. So my $150,000 principal investment could be valued potentially at $100,000, $120,000, somewhere around there. So now when I do the Roth conversion, I'm actually converting it at a taxable income. Let's just call it $120,000. I'm converting it at $120,000 of taxable income instead of $150,000. But the payoff is $150,000, and all the returns, the interest payments coming back from that investment are all now Roth, right? They're all tax-free. And so that's the way to hack your way to more Roth money for way less in taxes. In fact, Dimitri, the founder of my company that I work with at Sense Financial, he'll never make a straight Roth contribution again. He will always do traditional contributions, reduce his taxable income for the year as much as possible, invest in an asset that's non-public, like a note, for example, private loan, do a Roth conversion on the asset at a discounted rate, and then have more money in Roth for less taxes. So hopefully I explained that well enough for everybody to understand, but it is an advanced strategy. We had a bunch of people that jumped off in the last few minutes, so I'm sorry. I hope they come back and watch the recording, because out of everything we've talked about, Reed's stuff is amazing, but that last little bit, and I'm not taking credit for this, I didn't come up with it, but that last little bit could potentially be the difference between you having millions of dollars of tax-free ATM withdrawals in your retirement account versus not, if you take advantage of that. So super powerful. Reed's investments can definitely potentially play a part in that as well. So, my friend, I'll give you the last word. It's all you.
All right. Well, yeah, thank you all so much for attending. If you guys have any questions, feel free to reach out to me directly. Be glad to set up a time. If you're in Honolulu or on Oahu, I always have a lot of investors that say, they're on the mainland and they say, I want to come to Hawaii and I'm going to come there this summer. I say, great, let me know. I'll take you out to lunch. I always love meeting people face to face. It's just tough for me to do it from Hawaii. So, but if you're in Hawaii, obviously let me know. Be glad to meet you personally. And I appreciate the opportunity, Brett. And thank you all for attending.
Yeah, thank you very much, Reed. Let's do it again someday. Have a good rest of your day, buddy.
All right. Okay. You too. Take care.
Bye-bye.